Morning, afternoon, evening. Welcome back to Harvesting Income. This is a common question which I come across when I talk to people. They ask, should I buy an exchange traded fund, ETF, or should I pick stocks or buy a selection of stocks? What's the best deal? So this is what we are going to discuss about in this session, and I will take you step by step. I'll explain each of them, and each one has its own pros and cons, and also do a comparison to see what are the differences and what are the areas that show that this might be suitable for an X type of investor or that might be suited for a Y type of investor. So let's get started. So before we go ahead, just wanted to give a quick disclaimer. This is only purely for knowledge or sharing my experience, and do consult with a professional advisor or investment advisor before making any decisions. Okay. People who are new or just getting started or want to know what is a stock, this is a quick overview. A stock basically represents a part ownership in a company. Basically, the ownership in a company is divided into smaller parts, so the larger public can invest in the company, and the shareholders or stockholders have claim on the company's assets and earnings. So, being a shareholder, you have certain rights and certain claim on the company's earnings plus the assets. For example, if the company makes a profit, you have a entitlement to that profit, and the company might share that profits in the form of dividends or distribution, which they use to distribute the profits of the company to the shareholders. Corporations issue stock to raise funds or to raise capital, basically. Why do they do that? Can you think about an answer? Yeah, as you exactly guessed, this is required to expand business operations or invest in the growth of the company or come up with new products and services or invest in the research and development, etc. And these stocks are actually traded on stock exchanges where people can buy as well as sell the stocks. And any examples you can think of? Yeah, I think some of you already have the answers. Uh, some of the big well-known brand names like Apple, General Electric, Tesla, Microsoft, and so on. There are different types of companies, different types of industries or sectors. So this is all about stocks, and I'm quickly going to take you through the exchange traded fund, which is a different type of instrument to invest. Uh, exchange traded fund is also known as ETF in short. This is basically like buying a basket of stocks or a bunch of stocks. So imagine you're buying a combo or a kind of combo meal or a combo product, like where you get a different uh, components or items packaged into one single product or a package that is given to you. So you don't have to spend time using different stocks or different industries. So that is what an ETF is all about, and it could be based on an index. A part of the index could be carved out into an exchange traded fund, or it could be stocks within an industry or a sector. Let's look at more details. Uh, this ETF or basket is traded on the stock exchange, just like any stock, and it's little hassle free because you don't have to research and choose what kind of stocks to invest in, what kind of companies to choose. The problem is we have thousands of stocks and even hundreds of thousands of ETFs to choose from. So that's where the challenge lies. And ETF makes that much easier because you're able to buy the basket instead of picking individual stocks. For example, we have VOO, which is Vanguard S&P 500 Exchange Traded Fund, and you also have PY, which is the old G or a very popular ETF in the index space. These are two examples where the exchange traded fund is based on an index or an index which covers a wide spectrum of stocks and sectors across the country. Now let's get to the interesting part, comparing stocks and ETFs. At first, I'm going to compare the basic features and The second part, I'm going to look at some of the aspects of each in terms of portfolio management. And I want to just make a small note here. We are comparing index exchange traded funds with stocks to make a apple to apple comparison, to make a fair comparison, because there are different types of ETFs here. Okay. The first difference is you need a lot of research to select, identify, shortlist, and build a portfolio of stocks. Whereas in the case of exchange traded funds, you still need some research, but you have to do low or moderate amount of research, and it's much easier or faster to build a portfolio. This is obvious. Uh, Imagine you have five stocks in your portfolio. If one stock performs bad or if the company goes bad, then you're going to have a big hit on your portfolio. Imagine all stocks are equally valued. Out of five stocks, you have equal amount of money put in each stock. So if one stock goes to zero, theoretically, then you're wiping off 20% of your portfolio. However, in the case of exchange traded funds, you have minimal individual stock risk since you have like dozens of stocks in an ETF or probably hundreds of stocks in an ETF. One company's failure or one stock failing is not going to make a big difference to that particular fund. And the good news is you can even have multiple ETFs to diversify further. Like beyond each basket has a set of stocks, and if you have, if you have multiple baskets, then you have multiple diversified set of funds to invest in. So that makes it more diversified and more, uh, um, you know, more protected from all kinds of risks. The third difference is the tracking performance, which is difficult. You need to follow the company's results, participate in the company's conference call, follow the company news, what's happening in the industry, what's happening in the company. Whereas in the case of exchange traded funds, this part is pretty easy. Like it's published every day, you can track every day. You save a lot of time and effort. A lot of people think stock research is pretty easy and tracking is pretty easy. But the reality is because if you ask a person who's working in the research industry, equity research industry, they would tell you that the amount of time it takes to research companies and stocks and find out good opportunities, that's a very difficult task. Like for a normal person who has a full-time job or going to college or engaged into full-time occupation, it's very difficult to do that. And the fourth point is similar to the third point. Like this involves stock investing involves active involvement. You need to be actively involved in knowing what's going on with the company, going on with the industry, and so on. Whereas in ETFs, you can use the passive style. Passive style would be more like a set it and forget it style. And in the case of stocks, you are more reliant on your skills or your personal capabilities. You have to be capable. You have to be able to respond to different market scenarios. You are the master of your portfolio. Whereas in the case of ETFs, of course, you can manage your own portfolio, but the fund itself, the fund or the ETF product is managed by a professional manager. On the surface level, yes, you can always have multiple ETFs you can choose, but the investing part of it is managed by a professional fund manager. So that reduces a lot of risk in terms of operational and research risks because normal people may not have the time or inclination or the skills to do that kind of research. The fund managers or the professionals do, right? Nominal transaction costs, like, for every transaction when you buy or sell a stock, you might pay a small fee. So that applies in case of stocks. Whereas in case of ETFs, you have management fee. Some funds are very expensive, high fees, like which is more than 2% of the assets. Sometimes they charge lesser fee. It could be like 0.05%, like that. It's very small in case of index ETFs. So, so that's the comparison. Like you have the basic features compared against each other. I mean, in some respects, ETF seems to be a better option for new investors or someone just starting out, or maybe you don't have clue where to start. And for seasoned investors, stocks would be a better option. However, we will look at other features to get a better idea. Okay, in terms of rebalancing the portfolio, stocks are quite difficult to rebalance sometimes for an average investor because eh, a particular stock performs really well and doubles in value. Like now you need to manage that. Like, do you sell some part of it or hold on to it? And once you sell some part and book the profits, where do you invest the rest of the money? Like, do you withdraw the funds or how do you do that? So that part can be challenging, but of course you can also take the help of online tools or even financial advisors to do the rebalancing. In ETFs, it's pretty easy to rebalance, not that difficult, and you don't have to worry about choosing another stock or another fund because it's easier to find another fund rather than finding a new stock to invest because finding a new stock is not an easy task. You have to do a lot of research. Coming to the next part, like the income part of it, like, so we are about income investing, right? The channel is all about that. In the case of stocks, the income part is unpredictable. I would not say it is it doesn't work. I would say it's kind of erratic a little bit, kind of unpredictable or uncertain. That's the concern. Whereas in the case of ETFs, you can reasonably predict the income. I would not say it's a guaranteed form of income, but it's a kind of reasonably you can put a benchmark and predict that, hey, this is what I'm going to get every month. Probably it may vary, plus or minus 5%, but this is the income I'm getting. But in the case of stocks, it can be highly unpredictable. However, the appreciation potential is pretty high in case of stock, very high. Whereas in the case of ETF, it's very moderate. And if you want to build your own customized portfolio according to your, choice of stocks, or you want an a la carte, option, then picking stocks is the best option. Like because you want a kind of fine dining or a la carte experience, you want to try different options, and you want to manage it yourself. So that's the way to go. Whereas if you want a moderately customized portfolio, you don't want to, you know, go deep, go too much into the depth of like different types of stocks and different types of investing and all that. You want a more balanced portfolio, then go for ETFs. Okay. Now that we have seen the differences, now why pick stocks? Like why pick stocks? I think we have answered some part of the question before, but I'm just going to quickly summarize why someone would pick stocks. Uh, you know, you have good experience in understanding business and financial developments. Go for the stocks. And if you have the passion for tracking company results and news, yeah, stock investing is for you. You have the ability to value stocks, like how to put a value to a stock, like how to analyze the company's financials and future financial performance, and you are able to come to a value per share for a stock, and then you're able to see whether the stock is overvalued or undervalued. If all this sounds too complicated, then probably you have to reconsider. And you are someone who knows the professional aspects of investing as to when you make that entry and when you make that exit. So you know exactly, you know, when you want to buy, when you want to sell, and you have a clear strategy or clear plan of action. And you also have a plan B if things um, you know, things don't go as per your plan. And you're also not relying on the portfolio for income or early drawdowns. And you have a high conviction in the future potential of the company or the stock. That's another important point. So if you check most of the boxes, like if you check all the boxes, obviously stock investing is the strategy for you. But if you check most of the boxes, probably you're leaning more towards um, investing in stocks. And it's not about intelligence or ability to do research. It's the problem of having the time, inclination, tools, and sometimes you may not get access to some information being a normal person or an average person. Whereas a professional research analyst or professional fund managers have access to more information than you and me. So that's the point to keep in mind. Now I will move to the next one, which is why pick ETFs. Okay, easier to plan and manage, obvious. possible to go passive, set it and forget it. We already discussed that. And minimal impact of a single stock or a single point of failure. This is my favorite point, which I will touch upon later too. If a single stock fails, I'm not going to be totally, worried. I may be concerned, but I'm not going to be totally worried and panicked. Kind of, I'm going to sell everything and all that. I'm going to be more a little concerned. I have some time to respond, and I have time to, make corrective action if required. If not, I'm just okay. I can still, let it go and then reinvest some of the money into some other stocks or some other ETFs. For someone who is willing to take average or moderate returns, exchange traded funds are the best option. And if you need income or kind of a distribution, like every month you need an income or every quarter you need some kind of a dividends or distribution coming in, that makes you feel better that the fund is performing well. And that also makes you feel better because you can use that money to reinvest in other stocks, other ETFs. Wow, that's a great option. And the flexibility to rebalance or change your portfolio. So you can always, uh, sell something, buy something, you want to change the composition of your portfolio, you can always do that pretty comfortably with the ETF. So again, if you check most of these boxes, this is not a perfect checklist, but just to give you an idea, if you are checking all the boxes, then you're a passive investor, pure passive investor, I would say. But if you check most of the boxes, I would say you are kind of leaning towards um, index investing or ETF or passive investing. However, you can always use a mix of both approaches. And that's what we are going to discuss next. The decision, which is the $1 million question, whether to pick ETFs or stocks. I already discussed the extreme situations, like when you pick ETF or when you pick stock. That was an easy call. But the thing is, most of us have different styles of investing. Probably some of us are more oriented towards stock picking. Some of us are more oriented towards passive investing. In the first, blue line, you can see like the two extremes I've shown: stock picker and index investor. And there's a hybrid investor, which is kind of the middle path of the two. So if you lean more on the left, then you're a stock picker. Then if you lean more on the right, you're more on the index investing side. And the yellow diagram, which shows the two arrows, shows the same thing. And I'm just renamed it as active investor and passive investor, like just to give a generic idea. If you're investing beyond stocks, you can use the same model, like whether you want to go actively into that asset or into that instrument, or you want to go passively. And the decision making is somewhat similar. You could be on the moderate side, or you could be somewhere between moderate and passive, or you are somewhere between moderate and active. Like you could be anywhere in this spectrum. Okay, if you are there are different types of investing styles, like growth investors, dividend investor, hybrid investor. In this video, we are not going into that today, but we know to some extent that there are income investors, there are growth investors. Growth investors are mostly on the stock picker side. Income investors fall mostly under the index investing or hybrid investing style. The problem here is when I'm making a choice of what to pick, it's not about this versus that. You can use a combination of both. You don't have to be 50-50, or you don't have to be extremely on this side or that side. You choose which side you want to lean, and the choice would be based on your goals, needs, and how the investment is performing, as well as your own experience with certain products, or how you feel about it, how comfortable you are with that kind of investing style. That's the main, compromise on how you will choose your investing style. The second point is like about these things change over time, right? This once you put in a kind of portfolio, like it's not going to be stuck in stone, or set in stone for a long time. Like you're going to monitor the performance, and then based on that, you're going to make some changes. And based on changes in your life, probably you have different life stages or changes in your life, you are going to make some changes. And thirdly, but lastly, you don't have to pigeonhole into one of the styles. You don't have to get into one style to just prove that you are a certain type of investor. You can always use a different combination of styles. Even if you are a pure income investor, You can still invest in some growth stocks. It is not set in stone. It's not a kind of a hard theory that you need to follow. So feel free to use different styles or different aspects and benefit from each of them, like, and see what works for you. Like, each of us have our own preferences and we have our own experiences, and we probably lean towards different styles depending on the individual, experiences. So I would say have the broad framework in mind and make your own, pick your own choice. Yeah, this is the question that people ask me, like, do I hold stock? Am I all in on index ETFs? I'll first answer this and then clarify why I'm doing that. Uh, yes, I do hold some individual stocks in my portfolio because I follow those companies. I have conviction in those companies. Um, am I all in on index ETFs? No, definitely no. I have a few index type funds, but I'm not all in on index ETFs. I have different types of funds, and I'm more close to the hybrid style of investing, as we discussed in the previous style. And why move towards a passive or ETF approach? Or when I say move to passive approach, like, I'm not saying 100% move to the passive approach. You could move, a certain percentage, like 50% or whatever number works for you. It could be 30%, 50%, depending on your style or your comfort. You are moving to a passive approach to protect your capital or to generate some kind of income, and you want to reduce the amount of efforts or maintenance that's required for managing your portfolio. So basically, you're trying to minimize or eliminate this single point of failure. Yeah, so single stock failing or single company failing, that risk you want to eliminate. And remember, Warren Buffett's rule number one: never lose money. And rule number two, he says, follow rule number one. And you have to stay invested for the long term. Like, imagine buying a house versus, buying a house to just flip it off. Like, you're buying a house to live in. Like, so that's a long term decision. So if you have this approach in mind, then the chances of failure can be kind of curtailed or minimized. Although you have the risk in the markets, you still have the long term vision. You're able to ride through all the ups and downs. So that's the, beauty of long term investing. And so this is the approach I follow, and this is what I do. And if you keep following my videos, you'll know exactly what I do and know what kind of concepts I believe in. I will give you some examples of that. And as we come to the end of the video, I really thank you for all your time, all your efforts in watching and understanding the video. And please drop in your comments. And if you have any feedback or any other points that you want to add on top of what I have discussed, feel free to add your comments below. And you can follow my channel. The links are here. And you can also follow me on Facebook and as well as Twitter. And I have put my links here. You can take a screenshot or you can copy and follow me on those channels as well. And feel free to drop in your comments and subscribe to your channel if you like what you're seeing. And looking forward to see you in the next video. Thank you.